Hello and welcome to Stock Market Fever. Today is Sunday, May 1st, and we're going to look at an interesting options arbitrage play that could be quite profitable. In fact, you could quite possibly get a 50% return on your investment in just about 6 weeks on a stock that has already accepted a buyout offer. If you are bullish on Twitter, and why shouldn't you be, as Elon Musk has offered to buy out the entire company at $54 per share, then you can buy Twitter at $49 and wait and hold until it eventually gets bought out at $54. But you may have to wait quite a while, and you may wish to investigate an opportunity to get a quick and greater profit through a bull call spread that looks interesting and gives you additional leverage. Based upon the closing options on Friday, you could conceivably buy Twitter, symbol TWTR, May 46 calls at $3.60 based on the closing ask price. Twitter closed at $49.02, but even if you were to conservatively value Twitter on the closing bid price of $48.95, the intrinsic value of the exercise price and the stock's bid price would be $2.95. If you purchased a Twitter May 46 call at the closing ask price of $3.60, your net cost of exercising the stock plus $3.60 would be $49.60, excluding commissions and exchange fees. Now, for the other side of the spread, if you were to sell to open a May 49 call, then based upon the closing bid, you would receive $1.21. The cost of the spread would be $3.60 minus $1.21 equals $2.39. Okay, so what is your net potential profit and loss? Well, if the stock closed down below 46 on May 20th, you would lose your entire $2.39. That doesn't sound good, does it? But it is hard to conceive of this happening as the buyout offer is set for $54. Still, things can and do happen, so a loss is theoretically possible. But if the stock goes to 49 or higher, how much will you make? Well, you will net between the spread of the exercise of the stock at 46 and the sale at 49, a net of $3. Subtract your cost of $2.39 and your net profit would be 61 cents or $61 based on 100 shares. But let's run this by 10 calls. Then you are looking at spending $239. The net spread debit times 10 calls equals $2,390. Your profit then would be, instead of $61, would be $610, which translates to a 25% return on investment for a 20-day spread. But what happens if the price goes down to 48 on May 20th? Well, assuming you didn't buy back to cover, you would have a net credit on exercising of $2 or $200 for one call, which in our 10-call spread would be $2,000, so you would have a cost of $23.90 minus $2,000 exercise spread credit you would receive for a $390 net loss. Again, we do not offer advice, and this isn't a riskless transaction. In fact, you could conceivably lose your entire $4,800 on a 20-call spread if the stock falls to 46 on the expiration date. But on the other hand, let's look at how much leverage you would get. If you were to buy just 100 shares of Twitter Common, you would be tying up $4,905 based upon the closing ask price on Friday. Your maximum profit would be about $500. Okay. But in the debit spread example, if you were to purchase a 20-call debit spread for just under $4,800, you would have a maximum profit of $1,200 in just 20 days. If the price is unchanged 20 days from now, that's what you would have, and assuming you were able to roll out the spread for another 3 weeks, you'd bag another $1,200 for a $2,400 profit, and so on. In other words, you would have about a 50% return on investment in about 6 weeks. Is this risky? Absolutely. Any number of things, seen or unforeseen, could stop the buyout from happening. And the stock could have a temporary dip for any number of reasons to the $46 strike price or below, which would entail a total loss of your purchase. So, should you do it? What do you think? To paraphrase Clint Eastwood's Dirty Harry, do you feel lucky? Please leave your thoughts and comments below, as we'd love to hear from you. And be sure to like and subscribe for future actionable stock market alerts right here at Stock Market Fever.